I'd love to go over with you and just learn about the Fed. Like,
Yeah.
what is the Fed? What does that mean?
What is the Fed? Okay, so keep it as simple as I can. So the Fed is the central bank of the United States, right? And so the Fed's primary job, its mandate, is to keep inflation reasonable, like keep prices stable, and then to keep unemployment low. And so its general goal is to keep inflation around 2% and unemployment sub 5-6% or less.
Welcome back to Curiosity Class, the podcast where we break down complex topics into easy to understand ideas and bite-sized pieces. My name is Jeff Album, and I've been a curious person my entire life. Inspired by Albert Einstein's quote, "If you can't explain something simply, you don't understand it well enough," we aim to make learning accessible and engaging. On this show, we're going to bring you experts from various fields, ranging from personal finance to physics, to help you understand everything from 401ks to how airplanes fly. So let's dive in and satisfy our curiosity together. Welcome back to another episode of Curiosity Class. I am extremely honored and humbled to have William Ray on the show. William, thank you so much for being here.
Yeah, happy to be here.
So before we get started, I want to get into a little bit of your background and what we're going to be talking about today.
Yeah, and so my background, I have spent the better part of 20 years in commercial banking. So I went through a banking credit training program, then joined a commercial lending team where my job is primarily lending to businesses. And so worked for one bank for about 15 years, helped start up another bank for about 4 years, and then my new institution for about the last two, kind of running their one of their commercial lending teams here in Houston.
Awesome. So a little bit of banking experience.
A little bit. Yeah, pretty much all I know. So hopefully I'm helpful.
Well, yeah, like I said, thank you so much again for being here. I really wanted to talk to you today about just in general some larger finance stuff, just because I feel like, especially in today's day and age, you hear so much about interest rates and the Fed and all these kinds of things. And so I just wanted to talk to an expert in the field and just try to get a better understanding of what the heck does this all mean. So I think to start off, I'd love to go over with you and just learn about the Fed. Like, What is the Fed? What does that mean?
What is the Fed? Okay, so keep it as simple as I can. So the Fed is the central bank of the United States, right? And so the Fed's primary job, its mandate, is to keep inflation reasonable, like keep prices stable, and then to keep unemployment low. And so its general goal is to keep inflation around 2% and unemployment sub 5-6% or less.
And can you break down inflation? Like, what does that mean?
Yeah. So inflation is basically prices increasing, right? And so the goal is for prices to not increase more than 2% in any given year over time. So if they can hit 2% every single year forever, they're really happy. Obviously, probably you've seen recently, there's been a lot of inflation in the news. In 2021 and 2022, there was significant inflation, 10%, 10%-ish, maybe more depending on the category, which is obviously put a little pain in people's wallets. And so they've really been fighting that recently by raising interest rates. And so that's one of their tools that they have at their disposal is the Fed can actually raise interest rates, short-term interest rates, to try to slow down the economy and lower inflation.
So just to repeat that back to you. So inflation is basically how much prices increase in any given year. So
yes.
In those years where it was 10%, if something cost $1, after that year, that same thing would have cost $1.10.
Yes. Yeah. Okay. And there are several ways to measure inflation, but they try to look at it as core inflation, which is like they call it a basket of goods. And so they're basically saying, like, here's the average thing that Americans buying, taking out like energy prices and housing cost. And they say, like, if this basket of goods goes up X%, that's kind of the measure of core inflation.
Gotcha. So like stuff, right?
Yeah.
Groceries.
Basically, groceries, things like that.
Whatever Americans are buying. Okay.
Cars, yeah. Anything that you would buy, they're kind of like trying to lump it all in and say what, and they do kind of surveys and they say, how has the cost of this increased over the last year? And they measure it every single month, and that comes out every single month. And they do a 12-month look back trying to say, okay, where are we on inflation?
What's that? You said that it comes out every month. What comes out every month? What's that
So
report
there's
called?
basically all the data comes out every month. It's released by I can't remember the exact name of the group that releases it. I think it's the Federal Open Market Committee. It's related to the Federal Reserve. It's related to the Fed, and
Okay.
they are basically tracking this data every single month. And so every single month there's a new like inflation number that comes out, and it says, okay, well, inflation in this month went up. Like for the last month, I want to say it was like 0.3%, and that's just in one month, right? And so then they say, okay, annualized, that's closer to 4%, right? And so they're trying to look back over the last 12 months, but they're doing that every single month, trying to get a real good beat on what is happening. Because if you're only measuring it quarterly or annually, then you can't react fast enough to try to slow it down or speed it up.
So maybe this is a silly question, but what is the what does one thing have to do with the other? So if let's say what drives inflation or lack thereof?
So, I mean, the big thing that's going to drive inflation is it's demand, right? And so, or money supply, really. So, I would say what has largely driven the inflation of the last few years is that during COVID, we pumped about $5 trillion of new money into the economy to basically kickstart the economy. All the PPP loans, all that stuff that we did was new money. And so by adding to the money supply, when people have more dollars to spend, they spend them, right? And so just by having more dollars circulating, that's one of the things that can drive prices up, if that makes any
Okay.
sense,
So
right?
basically,
Basically, because so basically, there's a whole lot more dollar bills floating around to be spent, and so when you do turn around and spend them, there's an opportunity for prices to go up because that's just kind of how supply and demand works.
gotcha. Okay. Yeah, so the more stuff people are buying, the more those companies who are selling that stuff can be like, "Oh man, we have a huge demand, we can raise prices."
Yep. Yep.
Okay.
Yeah. It's basically, and it works on both sides, right? Because if the people have more money to spend, they're willing to spend it, right? And
Sure.
that's kind of what happened during COVID. Is all of a sudden everybody was flush with cash, and people still are. Generally speaking, people are economically pretty well off right now. It's just that things cost more,
Got it.
significantly more than they did even 4 or 5 years ago.
So is it fair to say that like when we talk about the economy growing, what that really
Mm-hmm.
means is people spending money. So when
Yep.
people are spending money,
Yep.
the economy is
It's
growing. When people are not spending money, the economy is not growing.
that's that's one way to look at it. Yeah, you're right around it. I would say it's also it's production, right? So the economy is growing is really you're talking about GDP, which is gross domestic product, and so
Okay.
that is really and that's a measure of how much we're producing in terms of just stuff and spending, if that
Okay.
makes sense.
So going back to the Fed for one second. So you said it's basically America's central bank.
Yes.
I know of a bank. There's a Chase down the street, right? So I
Yep.
go to Chase. I put my paycheck gets deposited there. I have an account there, etc. What are the deposits of the Fed? Is that taxpayer
Yep.
dollars?
No, and so the Fed, the way to think of it is it's almost like the bank's bank is kind of the way I look at it. It can be a
Okay.
lender of last resort. So it does a couple things, right? So like I said, its main mandates are monitoring inflation and unemployment, right? And then it's also what's called the lender of last resort. So if banks like actual banks, like a Chase, for example, does get into trouble, then they can go to the Fed to borrow money. And so, but the way the Fed helps with or tries to keep inflation in check and keep unemployment in check is by using what's called monetary policy. And monetary policy is basically controlling the money supply and dealing with interest rates, right? And so the Fed can set what is called the Fed funds rate, which is the rate that banks can borrow from the Fed, and then that in turn banks use that number to determine their what's called prime rate, and that is the rate that we go out and lend money to on a short-term basis. And so when the Fed is trying to control inflation or employment, they're going to if inflation is really high, then the Fed is going to raise interest rates because that increases the cost of borrowing, and so that usually slows spending down, right? Because if it costs you more to buy a house or it costs you more to buy a car on a car note, you might reconsider buying one. You might buy something, less expensive, and that's going to push down inflation.
Got it. So in other words, inflation is high, so
Yeah.
we want to stop people spending money, which will then stop companies raising prices. So hopefully
Yep.
prices will come down a little bit.
Yeah, well, so you don't want prices to necessarily come down because that's a deflation, and that's
Okay.
actually kind of a scary thing. But what you want is the increase in prices to come down, right?
So
So
the
so
rate
yeah,
that
you don't want
prices are
prices
going up.
to yeah. So you want the increase of prices to slow down to that 1 to 2% rate.
Got it. Got it. Got it. Okay. But the Fed doesn't actually have any money to lend, right? Or
It
how,
does.
how,
No,
how
no,
does that work?
it does. It has the dollars. I mean, technically, the banks themselves are the ones kind of distributing the dollars to the consumer, but the Fed can print money, so to speak.
Okay. So got it. So like tax dollars don't go into the Fed. Tax dollars go
No,
into do you know where tax dollars go?
they go to the federal government, but not to the Federal
Okay.
Reserve.
And okay, so those are separate entities.
Yes, so the Federal Reserve is part of the federal government, but it is an
Okay.
independent institution that was formed, I want to say, like 1913, something like that. Because basically, before the Federal Reserve was formed, before we had a central bank, you just had these crashes and these spikes, and like the asset, it was just a mess. And so the central bank is really like its whole job is to smooth things out, right? So you don't have these massive asset bubbles, these massive crashes. Like its role is to kind of be a middleman in a way, and kind of a damper on, like, massive enthusiasm on certain asset classes, right? It is there to say, let's keep this thing steady because a steadily growing economy is good for everyone.
Got it. Got it. Got it.
Boom
Okay.
and bust is a big problem.
Got it. Okay. So the Fed, America's central bank, they are tasked with monitoring inflation and
Yep,
monitoring unemployment, and they do
yep.
that in a number of ways. One of which is raising and lowering the federal funds
Interest.
rate, which
Yes.
is that the interest rate that everyone talks about today?
So the federal funds rate is the rate. Yes, it is.
Okay.
Whenever you hear like, oh, the Fed raised rates, they're
Yep.
talking about the federal funds rate. And
Okay.
so, the federal funds rate is the rate at which banks can borrow from the Fed. And
Got it.
so
Okay.
then we turn around and we set our own rate, which is usually about 3% above the federal funds rate. And that's
Okay.
called prime. So today, the Fed funds rate is at 5.5%. And so that means the bank's prime rate, it's called Wall Street Journal Prime, is at 8.5%.
Got it. And so you said we, meaning like a commercial
The
bank.
banking industry in general, usually we all fall in lockstep. Everyone's prime rate is the same.
Got it. Okay. So because you're basically going to the Fed and saying, "Hey, Fed, we want a loan," and they're going to give it to you at 5.5%, which is the federal funds rate. And now you're going
Yep.
to go around and make loans or doing whatever you do, but
Yep.
you're going to lend that money out at 5.5
At
plus three
prime, at
percent,
prime,
which
yeah.
is prime.
And prime is what we say is we're offering to our best customers. And
Okay.
so, but if you were to go get like if you're putting money on your credit card, or if you're buying a car or something like that, you could be at prime plus 1%, prime plus 6%, prime plus 10%. Like, and so that's all based on risk, and that's how banks set their pricing is usually based on the risk associated with it.
Got it. Okay. So the risk of the borrower, the higher the risk, the higher the interest rate needs to be.
Yes, to
Okay.
offset that risk.
Okay. Gotcha.
Yep.
Gotcha. Gotcha. And so is there another rate that the Fed sets, or that's the federal funds rate is the
No,
only one?
that's it. And so like that's the short term rate, right? And so short term rates and long term rates, usually there's a little bit of correlation, but long term rates are set by kind of market expectations, right? So what does the market expect rates to be in the future in 3, 5, 7, 10, 20 years? But that's not driven exclusive. That's not driven by the Fed. That is driven by market forces. So if the market believes that in 5 years the rates are going to be lower because maybe the economy is going to slow down and the Fed's going to have to lower rates, then you'll see like longer term rates could be lower than short term rates.
So what does that mean? So you said short term rates is the federal funds rate.
Yeah,
What is an example like? I know you said long term rates are set
a
by the
long term
market,
rate
but
would be like, think about your mortgage, right? So if you wanted to go out and buy a house and put it on a 30-year mortgage, or if you wanted to buy a car today versus even 3 years ago, the long term rate is significantly higher than it was a few years ago because, like, and I said they're not completely disassociated from one another. So if the short term rate is higher, you can usually expect the long term rate to be higher as well. Um, but that they're not tied directly together because long term rates are more based on, like I said, expectations of where rates will be in the future.
got it. Got it. Got it.
Yeah.
Okay.
So,
that's
but basically the cost to borrow has just gone up significantly because we're trying to slow down this inflation because we're
sure.
still running at around 4% year over year,
Okay,
and
so
we
we're
want to
getting
get
a lot better than
we're getting
10,
it's
but
better. It's definitely
yeah,
better. But when you ran so hot at high inflation for so long, prices have gone up so much that it feels like even more because the U.S. has been in a pretty low inflationary environment for 15 or 20 years since 2008, and so when all of a sudden we had a pop of high inflation, it was kind of a shock to the system.
sure. And that was also the period of essentially zero interest rates, right?
Yep. Yeah. So we had more or less 15 years of zero interest rates. Rates started to move up a little bit in 2018 and 2019. And then when COVID hit, we dropped them right back to zero.
And so
Or
zero interest rate, the Fed funds rate was at
the
zero.
Fed funds rate was zero. And then so Wall Street, or 0 to 0.25%. And so the Wall Street Journal Prime was more or less 3.25 from 2008 till 2020, late 2021, 22. Yeah.
Gotcha.
It is a
Okay,
while.
got it. So we all kind of got used to this idea that, oh, cool, money's free. And then
Mm-hmm.
now that rates are probably
It drove a lot of interesting decisions. I'll say that for sure.
would have been a great
Yeah,
time to buy a house, though.
it was, and those mortgages are both an asset for some people, and they also probably feel like an albatross because you cannot move.
Right.
You can't trade out a 3.25 or less. I mean, I know people who have a 2.5% 30-year mortgage,
Yeah.
and guess what? They will
They're
not
staying.
move
Yeah.
anytime in the next 5 years.
Yeah. Oh man. Okay, so that's a perfect segue into mortgages. So you
Yep.
said that so mortgages is an example, and for anyone that doesn't know, mortgage is basically a loan for usually a house, right?
Yep. one Hundred
Right.
percent.
And so
And so yeah, and so your typical mortgage, you have to put 20% cash down, and then and then the remaining 80% is funded via a loan from a bank or a mortgage lender. There are non-bank lenders who do this as well. All this is supported by government institutions, and they're called Fannie and Freddie,
mhm,
and they're basically they kind of set well they provide a backstop for all these mortgages, and so basically, you kind of have a fixed product, and the rates are pretty consistent across the country. I mean, you might have special rates here and there, but it's a pretty straightforward product. You have to meet a certain standard. You have to have a certain amount of income, and basically, the way you get a mortgage is it's called a debt to income calculation, and I think the maximum is allowed at like 42 or 43%. So, and that basically means can is your debt payment no more than 42 to 43% of your gross monthly income, like
right.
for
So
your
if you make
total
100
debt.
grand, whatever, 42, so 40, your payment cannot not be more than 42 grand a year.
Yeah, it's a monthly calculation for what it's worth. It's the
Sure.
way the
So
yeah.
100 divided by 12 and 42 divided by 12.
Yep. And so, but mortgages, I mean, like they're uh, even today, when you have 30-year mortgages costing 7%, that's historically about average. Like I said, like we said just a minute ago, is like I think everybody got um, used to rates that were like ahistorically low, right? I mean,
Hmm.
average rates have been 6-ish% for going back 50 or 60 years, and then all of a sudden we had a 15-year period where they're 3.25, and so you have a whole generation of people who that's all they know,
Right.
and it's
And
just I don't think we should expect that at any point going forward.
and when you're saying rates, you're talking about the kind of the consumer rates that we see,
Yeah,
right? So
mortgage rates, just short-term interest rates as well. Outside of some kind of major shock to the system that causes other economic problems, I don't see us going back to three to 3.25% rates. Um,
got it.
I'd say this is
Man.
like the way to think about it is to get to low rates, something bad has to happen,
Sure.
right? And so that would mean that the Fed believes that the economy needs a boost, and so we need to drop rates significantly. It's one thing if they were to lower rates, 25. It's called 25 basis points, which is 0.25%. So every
Okay.
basis point is 0.01%. So a 1% is 100 basis points. And
Got
so
it.
typically the Fed only moves in uh, 25 basis point moves. Occasionally, like when rates were going up recently, they were doing it at some points 50 basis points at a time.
Okay.
But like during the 2008 financial crisis, during COVID, you saw 50, 75, 100 basis point cuts, and that means that there's a crisis, and so you typically just don't want to see massive cuts because that probably means we're in some kind of economic crisis. What you want to see is like, okay, maybe the economy's softening, we can lower rates 25 basis points, and we'll leave them for 6 months and see what happens, right?
Got it.
And so, yeah, where we are today, I think a lot of people would love to see rates come down a little bit, but I don't think anyone really wants them to come down to where they were because that probably means something bad happened.
Right. Okay. I want to go back. It's a little kind of roundabout, but I want to go back to the money supply for a second if we can.
Yep.
So we've been talking about, just like what happened during COVID and these interest rates, these zero interest rate environments, as well as, like during COVID, we increased the money supply. Who's responsible for the money supply? What does that mean?
That's the Fed.
That's the Fed.
Yeah.
Okay.
Yeah, so that's a monetary. So it's the Fed. I mean, but that was also driven. Well, I'll say this: that was driven by Congress and the legislature passing. I want to say it was the CARES Act, which is which is where all the PPP funds came. And so we just printed money, like, and that was that's more of a fiscal policy. That was like hey, we're gonna put money in people's hands because people can't work, and we created that money out of thin air.
And so
those new dollars.
Is fiscal policy that's more an act of Congress and less an act of the Fed?
Yes.
Okay. So monetary
fiscal policy is usually taxing and spending, whereas monetary policy is printing new money or reducing the money supply.
Got it. Okay. So I'm just so interested in this because I've never quite understood how the U.S. government functions, because it seems like we get, they collect money in terms of taxes, and that's basically it. That's their only income, right?
That's it.
And then they spend that money doing, roads, bridges, government employees, government agencies, etc. Usually there's a difference, and that's called the deficit, right? That's the debt that
Correct.
we have. So how does that work? Like, if you're a household and you're consistently bringing in money and spending more money, that's bad, right?
Yeah.
But for some reason, it's totally fine when it's a government. So how does that work? How do we understand that?
It's and this is really I would say people have different opinions on this, right?
Okay.
I would say when you have a really strong economy like we do today, we probably shouldn't be running a deficit, right? But the only way we're going to get to either neutral or some kind of budget surplus is going to be some kind of combination of raising taxes and spending less. I don't think one lever or the other is not going to be enough to get us there, and both of those are wildly unpopular.
Right.
And so if you ask why can the U.S. government consistently run a deficit and we're running up massive debt, I want to say that we're somewhere in the $34 trillion range of debt for the U.S. government. It's because we have the full faith and credit of the world, right? Because we are the world's currency. The U.S. dollar is the dominant currency in the world. I want to say it's used in something like 70% of the world's transactions, and so it is our strength that allows us to borrow like this because everyone trusts that we'll be able to pay our bills,
right?
Even if it looks like we're running up a lot of credit card debt, they're like, no, they're fine.
Got it. Okay.
There might look, and the truth is, there might be a moment when that is not the case anymore, and that's a scary concept.
Right.
Because what that'll do to markets and interest rates, I couldn't begin to fathom to guess. I would imagine it would spike them, right? If the U.S. government had to borrow at a higher rate, then everyone has to borrow at a higher rate. That's just because if they're less safe than if people think that the U.S. government is safe, think about how safe they think the U.S. consumer is, right?
Right. So with that, so when the U.S. decides, hey, we want to, we have this debt that we want to cover. So do they usually print money or do they usually borrow money? And so to ask that in a different way, both. Okay.
Both.
So
we're like constantly borrowing. So the Fed, we issue treasury, like it's treasuries, right? And so there are short-term treasury notes and long-term treasury notes. Basically, the government issues debt that creates money to pay our existing obligations.
So okay, so let's say
when the government's paying, so the government issues treasuries, when the government issues right now, I want to say that treasuries are really short term or somewhere in the 5% range, and this is years ago they were much lower, and so that the government has an increased cost of borrowing, and so you're probably hearing more about the debt and the deficit now because the government is actually having to pay real interest costs, right? Like we're actually paying, like, on top of everything else, we're paying something like $1 trillion plus of interest a year. And so that starts to add up really quickly.
Sure. Okay, so we threw a lot of numbers out there, but let's
Yeah.
try to kind of clear it up a little bit. So,
Yeah.
okay, let's say the U.S. government collects, just to keep the numbers easy, $1 million every year in their total revenue. They
Yep.
spend $2 million. So there's a difference. There's a delta of $1 million, right? So of that, they borrow, let's say, half, and then they print, let's say, half.
They're borrowing
fair?
most of it. But by borrowing, they're printing, if that makes any sense, right? By issuing these treasuries, like they're adding to. I want to say I'm getting this right, and I apologize if I might be like slightly off on this. But basically, like, we're consistently issuing what's called bonds, these treasury bonds, and that's the debt issuance. That's the U.S. government saying, "Here's our debt," and they put it out into the open market, and people buy it. And other it's not just people; it's other governments. Other plenty of people are happy to have our debt because we're still paying on it on a current basis. So, when we're issuing these treasury bonds, the U.S. government is paying, every month, what's called a coupon rate. So if they're issuing these treasuries at 5%, then we're paying that. So people are happy to say, "Oh yeah, I'll take 5% from the U.S. government all day because that's safe."
Got it.
Does that make sense?
Because we have the full faith and credit. But so this,
Yes.
it's like this is all just an idea. This isn't.
Yes. No. It's all. You're 100% right, and it's called fiat, FIAT, fiat currency. It's the idea that, like, the dollars that we're issuing, they only work because there's a belief in them. There's no underlying asset. There's not gold. There's nothing, like, they're not tied to anything aside from the fact that we say this is money, and so take our money.
That's
fiat
so
currency.
Crazy.
Yeah.
Which then I feel like another whole conversation could be crypto and all that.
But there are reasons for that, right? Like, because if you're tied to, like, call it used to be the gold standard, right?
Right.
If you can't issue money, if you're tied specifically to an asset, then your money supply never grows, and it's a real drag on any kind of economic growth.
Got it.
So
got it.
There's a lot of good economic theory behind what we have done. We might have gotten over our skis on the deficit a little bit. Okay. That's personal opinion.
So the government is issuing debt, and so that's called a bond. So when the government says, "Hey, we have $1 million worth of debt that we need to cover," we're going to issue a bond. So we're going to create 1 million little bond notes, and they're called treasury notes, right? And we're going to say, "Hey, great, anyone can go buy these, and we're going to give you 5%, whatever that interest rate is, which is called a coupon rate." And so individuals, other countries, even, I'm assuming some sort of probably investment funds,
other institutions, banks, everyone's happy to buy this debt up, right?
Okay.
And then they're constantly, like, and they're issuing it over different maturities, right? So it can be for a month or 6 months or years or 10 years. And people are making decisions on if I'm willing to accept that rate based on the risk associated with it, right?
Got it. Okay, because they're typically seen as safe because we have the full faith and credit. It's the U.S. is the borrower.
Yeah, the U.S. is the backing, right? Because there are other people who issue bonds, like the city of Houston or the city of Austin, like their municipalities, they issue bonds as well. School districts issue bonds to build schools. They pay higher rates than the U.S. government. They have to because there's an implied higher risk associated with smaller governments. I mean, companies issue bonds. And if you're an A-graded company, if you're, like we mentioned Chase earlier, Chase can issue bonds and they don't have to pay as much. Whereas, some much smaller publicly traded company that tried to issue bonds probably has to pay a higher rate because they're viewed as riskier. So generally, like, the thing about interest rates is, like, the price that people are willing to accept, or the rate that people are willing to accept, is going to be tied to the risk associated with who is repaying them. And that's why the U.S. government pays the lowest rates, because everyone views us as the least risky, and rates go up as risk goes up.
Got it. Okay. So these bonds are being issued by the called treasury bonds. We can buy them. And then you mentioned that the U.S. is now paying a very high percentage of its of its payment into interest. I think you said $1 trillion.
Yeah.
Is that just because the bonds from 2021 that they issued are now coming due, or like what?
Yeah.
Why
Well,
is that?
it's generally, so we just have a very high debt burden and a much higher interest cost. So you have two things going on at the same time, right? We've added, I don't know, 10 or 20 trillion dollars to the deficit, to the U.S. debt in the last decade or so, and that you didn't have as much interest payments, like actual current interest payments, until rates started going up here in the last 2 or 3 years. And so, so now on top of just the fact that like we have what I would call it, you call it like an operating deficit, like we're just spending more money than we are bringing in. We also now have the debt burden, like the interest burden associated with that debt. So that's a whole separate kind of line item that really wasn't there as much in the past.
Okay, I'm gonna try to
It's
explain
one,
that
it's
back
one
to
more
you.
thing we have to pay,
Sure,
and,
sure.
and it compounds on itself. And so that's one reason that a lot of people think that rates could come down in the future, is because the U.S. government itself really kind of needs to pay less.
So, okay, I'm gonna try to explain that back to you. So,
Yeah.
in the last, let's say, 15 years, when the Fed funds rate was approximately zero, the government could issue bonds at approximately or close to 0%.
Yeah, I mean they're
So,
going to be. So I mean they're typically issuing them on a longer term basis. So they're I mean yeah, they're closer to zero than they are to 5 or 10. Yes.
got it. Okay.
Yeah.
So they're issuing bonds, which is essentially their own debt. So they're basically
Mm-hmm.
giving themselves, they're saying, hey, we want to raise money, so we're going to issue these bonds. People can pay these bonds, but the interest on those bonds are very low. So that means
Yep.
that people who bought those bonds as an investment are getting a low return, but also on the other side, the government has to pay a smaller amount of interest on those bonds.
Mm-hmm.
Now,
And
in the
people were
last,
happy with that. And people were happy with that because if they're getting 1 or 2%, um, before rates went up, if you just had your money sitting in a bank account, you were getting zero. And so you were
got
saying,
it,
okay, well, I'll take 1 or 2%. It's worth something, right?
got it.
I'm happy to do that.
So it's not a, you know, shiny, fun investment, but it's safe,
No,
it's
it is
boring,
it
it's
is the safest, and that's the idea behind it. Is like you're just clipping. It's called clipping a coupon. Like you're just happy to get your 1 or 2%. Now it's 5 or 6
got it.
percent. And so I think the thing one thing to mention is like there are a lot of people who buy bonds and they're just happy to get their coupon, but as interest rate move, that actually impacts the value of the bonds you're holding. And so if you were to want to sell a bond, after like let's say you bought a bond and the coupon rate was 2%, and now the prevailing rate is 5%. The value of that bond has gone down significantly,
Sure.
because if you wanted to trade it out, someone is going to pay you less because they can get 5% somewhere else.
Right.
So they're going to pay you less for your existing bond. So like if you bought it for, let's say it's $100, right, and it's paying 2%, and now rates are 5%. Well, someone's not going to pay you $100 to get that 2% coupon because they can get 5% somewhere else. So they're only going to pay you, say, $95 or $97 to buy your bond. So the value of your bond went down so that they can match the rate that they can get on the open market. Does that make
Sure.
sense?
Sure.
So
Sure.
so they're going to pay you less for that bond, and so then they can own it. But then since they paid you less, it makes it so that even though that coupon is only 2%, at the end of the day, when that bond matures, they paid you 97 cents or $97, and they got
Yep.
100. Then they get $100 plus the coupon that they've been clipping.
So why, if someone could get a way higher interest rate on a new bond, why would they buy an existing bond at? If someone has the option to
I
buy
mean,
a bond at 5%,
just think about it like it's kind of an open market concept, right? It's like because there are going to be people who need to sell those bonds because they might need, because some people, I mean, it's a massive market in terms of bond trading, right?
and that's
And so
called fixed income,
people are
right?
buying and selling them all the time. Like it's not most bonds are not just bought and held to maturity. That's not how it typically works. They're usually traded in the open market, and so there's always someone who's going to want to sell their bond, and a lot of traders, financial professionals, might think that they can get just like a little more yield by buying a bond on the open market and getting a better discount to, as opposed to going out and like, I'm going to buy the U.S. Treasury at 5%. Well, I think I can get this at enough of a discount so I can get 5.02%, right? And if
Hmm.
you do that enough times with enough dollars, it makes a big difference.
Got it. Got it.
So
Got it.
that's
Okay, I
why
see.
there's an open market, and people are, it's gambling. Really, at the end of the day, it's like, it really is. And so people are kind of, people are guessing. I mean, they're educated guesses. They certainly are. And there are people who are much smarter than me who do this every single day, and who are trying to just win on like the narrowest of margins, over and over and over again, and it adds up.
Gotcha. Gotcha. Okay. Wait, I want to finish the point on the government interest payment though.
Yeah,
So the reason that they now have a higher interest payment is because now recently they've been issuing bonds at higher
yep,
interest rates. So that means that their own payment is now higher, and so
yep,
that's the main issue,
yep,
right? Okay.
yep, yeah. Higher rates, and so you have this big debt sitting out there, and rates are higher, and so and these bonds are constantly rolling. So there are some bonds that are still out there. Some you know uh, yeah, treasuries that were issued years ago still paying 1 or 2%, right?
Sure.
But those have changed hands multiple times, and you still have other debt coming on that's new that is at higher rates. Yes.
Got it. Okay. And that's a good point to say. So of the, whatever, $30 trillion or what have you that the US is in debt, that's not all. Those are a
It's
ton of different
blended.
bonds. Right. Right.
Yeah.
Okay.
And so
So it's not
I
like
couldn't tell you what like the blended rate that the U.S. government's paying today on all its debt. I don't have that number,
oh,
but
that'd be
would be a good one
interesting.
to find out.
Yeah. That'd be really interesting. Okay, got it. So when people are saying like, "Oh my God, interest payments are so high," da da da, that's true, but only on a certain percentage of whatever new bonds have been created in the
Yeah.
last whatever
Yeah.
3 years.
But if you think about it, if you think about how the size of the deficits we're running,
Right.
then that's why it's adding up so fast. It's because we're issuing it new now.
Oh
And so
wow.
if you're running trillion plus dollar deficits,
Every year.
yeah,
And if when people talk about their mortgage and how to pay a loan, right? If you have $100,000 loan at 5% interest, $5,000 every year of your payment is not touching your principal, your 100,000 of your actual money, right? So
yeah,
interest payments don't pay down your loans at all,
nope.
which is why it's so easy to get into
This is
credit
why
card
that's
debt.
why our debt's going that way. And
Yeah,
yeah, it'll take it will take a surplus to bring the debt down, like a budget surplus, and so and that would it's going to take a lot of political will, I would say, to do
but
that.
even if there was $1 trillion surplus every year, it would still take an
Yep.
insane amount of time to pay off that debt.
Mm-hmm. But the truth is that would be fine. Like there's the question really. I think, and this is a big economic question, is like, at what point does
Stuff
the open
break.
market do the open markets believe that the amount of debt the U.S. has is too much? And
Right.
so it clearly believes that we can handle what we have and more because we're still issuing it. Um, but the question is, if there's a tipping point that we say, okay, we have to get our house in order, and we can maintain, because the odds of us ever getting this debt down to zero, I mean, I don't see it happening. It's not going to happen in our lifetimes.
Right.
And I think the real question is like, can we keep it manageable, and what is that number?
Got it. Got it. Got
Yeah.
it. Man, that's crazy. And then
It's
I guess
tricky.
the follow up question to that would be, of the world's largest economies, what are the other top 10 countries look like? Right? Like is this normal to kind of the world, or is this unique in the sense that, oh, America is the only one who's running these crazy debts and have these high interest rates and their payments and da da da
Yep.
da.
We're kind of special in that regard. I mean, look, most advanced economies run some deficits. We just I think we probably have the one of the highest, if I had to bet, in terms of. But the difference is we're also the world's largest economy, right? And
Sure.
a big number that people look at is your debt to GDP ratio, right? And so people, the big question is like, at what point, and I think the U.S. is somewhere around 100%. Like, I mean, we have a massive economy, right? And so it generates tons of revenue, tax revenue, and that's what allows us to sustain a little bit of higher debt. We're just bigger. Like, we just produce more than pretty much anybody.
And so GDP is gross domestic product. That's measured in dollars, right?
Yep.
So that's
Yep.
essentially the total output of the
Mm-hmm.
U.S. economy.
Yeah. And the
in
thing
a
is that
dollar
we've never
figure.
defaulted on our debt. We've always paid as agreed. We've had some moments where it might have gotten close recently with different government shutdowns and whatnot, but we pay our debts,
Okay.
and so we're having the full faith of the U.S. government goes a long way. But
Right.
we're in terms of developed economies, I think we kind of stand alone.
Okay. Man, that's so crazy.
Yeah,
I just
yeah,
my mind's blown that it just keeps coming back to it's basically just this idea that people have faith in us.
yeah.
And that's
It's
kind of it.
it really is, and it's a fascinating concept, and that's why when you if you go down the path of potentially shutting down the government, defaulting on our debts, like the the aftershocks of something like that I don't think people quite have a grasp on how bad that could be,
Right.
because we get to do what we do and spend how we spend because we are so consistent.
Right.
Yep.
Holy smokes. Okay. So avoid that scenario.
Yeah, yeah.
That
Don't
would be
default.
not good. Okay.
Yeah, I mean that's a personally, professionally, don't default on your debts. It does not work out well for you. Like pay what
Okay.
you owe.
Okay. That's a good piece of advice right there.
Yeah.
So okay, so now I want to move on to a little bit onto banks themselves. So
Mm-hmm.
a typical Chase Bank, Bank of America, how do they make money? How
Yeah.
do they operate? What does
So
that look like?
it's in the simplest terms, it just comes down to loans and deposits, right?
Okay.
So basically, the bank we take in deposits and we pay you for your deposits. So let's say that today, at the highest rate, the highest deposit rate is like 5%. So we're going to take your deposit in, pay you 5%, then we're going to take that deposit and loan it out, and then we're going to loan it out at 8 or 9%, or more
And
if we can.
does it matter what those loans are for? Are those for houses? Are those for
The only
business
thing that
loans?
matters is that they're safe and that we get repaid. So that's
Okay.
the biggest thing, is that ideally we get every single dollar of every loan we make back. But where the banks make money traditionally is on the spread in between the amount we're paying for your deposits and the amount we're getting paid for our loans. And so typically that's in the 4% range. Ideally, you're 4 to 5%. If we're in a good environment right now, it's probably in the low to mid 3% in terms of our interest. It's called your net interest margin, and that is the difference between your cost of what you're making on your loans, and then your cost of your deposits. And
Got
then
it.
banks also make fees. The bigger banks are really fee driven, and they can do that via tons of different ways, either retail, either like insufficient funds charges, or via or just loan fees, bond issuances. They do all sort, like bigger banks do all sorts of other things. But if you're talking about like the core community bank, regional bank, what are they really focused on? Loans and deposits, and just making that spread.
Got it. And that
Yeah,
spread of what they're paying out in interest to us as the consumer versus what they're loaning out that money for
yeah,
to
and
their
that's
business
and like I said,
operations.
and that in good times that's 4 to 5%. Today it's 3 to 3.5% for most banks probably,
Okay.
and that's our net interest margin. And so that's our net interest margin is kind of like your really kind of your, if you want to look at it, the kind of your revenue, right? Like that's where like your kind of net revenue, and then below that is you have to the cost of operating the business, the people, personnel,
Office space.
insurance, systems, all that fun stuff, right? And so ultimately, banks, our net, what we make is about 1% on our total assets. And so if you're a bank, let's say if you're $1 billion in assets, and your assets are your loans. So if you have $1 billion in loans, on net, you're going to make $10 million. So
Got it.
banks are a very, very low margin business, and that's why we have to get repaid. Because if we make a bad loan, like it can really, if you make a series of bad loans, if you have a lot that go that don't repay, then that'll crater a bank pretty quickly,
Got it.
because we just don't make
Got it.
enough
Got it.
money on net to make up for the fact that someone didn't repay us.
Right. So that's and also probably why it behooves banks to have larger deposits, therefore, so they can make larger loans, so they have more dollars to play with, so to speak.
Yeah. Oh, and we're also, for what it's in, like, so banks are highly regulated, and
Hmm.
so and the Federal Reserve's involved in that. For some banks, and then national banks are regulated by what's called the OCC, which is the Office of the Comptroller of the Currency,
Okay.
and those regulations are are all put in place to make sure it kind of protect us from ourselves, to make sure we don't do things that would put us at risk, that would create systemic risks. And one of the big things is that banks have legal lending limits, and so you can't lend out more than 25% of your bank's capital to any one borrower. And so when you're a Chase, like this is just never going to come into play. It comes into play when you're more of a community bank or a regional bank,
Mm-hmm.
because the whole point of that is saying, okay, let's say I brought in like $1 billion bank is typically going to have about $100 million in capital. That's what banks usually are around 10% capitalized.
Wait, can you
If
explain that?
that'll help. So capital is like the equity in your business is like and that comes in two forms, right? Usually it's how much people have invested to start, in this case, a bank, and then how much money you've made over time and left in the bank. And
Okay.
the general regulatory requirement is that we need to have somewhere between around 10% of our total assets in capital.
Where do deposits fall into that? Is that considered capital?
It's separate. So if you want to think, so there's assets and liabilities and equity in terms of like what a balance sheet looks like, on
Okay.
any business. For a bank, our assets are our loans,
Hmm.
our liabilities are our deposits, because technically we owe you your money back.
Right. It's reversed
Right?
from the
It's
consumer's
flipped.
perspective.
It's
Okay.
flipped, because normally your cash on hand is your asset. For a bank, it's the opposite.
Got
And
it.
the difference between those two is your equity, and that's the bank's capital. And so every bank has minimum capital requirements, and it's tied to your asset size, right? So banks, you can't be a $10 billion bank with only $100 million in capital. That does not work. You have to,
Got it.
like, it's basically 10%. And
But
so then, yeah,
is your capital tied to your liabilities then? Because
well, it's tied to both, right? It's the delta between assets and liabilities.
okay, okay. So, but so the 10% capital. I'm sorry.
Requirement. That's a requirement. So that's a general thing. So you can't. And that's put in place. That's a regulatory requirement that is put in place to keep banks from. It's called over leveraging. And
Mm-hmm.
so it basically means that, like, hey, look, you need to have some amount of capital on hand in case you have bad loans, in case there's a downturn. Like
Sure.
that's really why it's in place. It keeps banks from kind of overheating.
And so, just to put some numbers to it, let's say you have $1 million in deposits, which are liabilities. How many or what dollar amount of loans can you give from that $1 million in deposits? That would be your bank's assets.
So technically, right now, you could lend out 100% of that. There are no reserve requirements today. There are
For
capital requirements.
deposits.
They're kind of different. It's a little tricky, and
That yeah.
I'm going to try to boil it down, because there have been 10 to 25% reserve requirements to say, hey, you cannot lend out 100% of your deposits. The reserve requirements actually went away during COVID and have stayed at zero, but there are still capital requirements, which are kind of like your base. Like, you have to have equity in the bank,
But
in terms of like retained equity.
so let's put some dollars to that, just because I'm not understanding
Yeah.
how we get to equity. So let's say you have $100,000 of startup costs. We'll call that your initial
Mhm.
equity, and $1 million in deposits. Go.
Yeah. So then you could loan out. So in that case, if you have $100,000 in startup, you have $1 million in deposits, you could put $1 million in loans out, because
Okay.
that's going to be that 10 to 1, right? So
That's
you
that 10
could,
to 1. Okay.
yeah, ish.
Wow.
That's
So
roughly. And so the whole that's called fractional reserve banking, and
okay.
the whole point of that is the Fed. Like, we have our capital, and then we have these deposits, and then we in a not in a way, we actually do add to the money supply, because we're not forced to retain 100% reserves. So, like, we're loaning out more. Like, we're more or less creating more dollars, because we're loaning out every dollar you're putting in. We're loaning more out. We're creating even more money, and that's going into somebody else's pocket, and
Right.
then they're
Right.
depositing it somewhere else or with us, and we're loaning it out. If that makes it so, it kind of builds on itself. It's a um, and so the Fed can, if they want, they can increase reserve requirements. That'll decrease the money supply. That'll slow down inflation. They haven't done that. Um, that hasn't been a lever they've pulled, but it is one they have at their
Okay.
disposal.
So again, kind of it comes back to the fact that it's a lot of faith. Like if you're
A lot of
able,
faith.
banks are,
No, the faith in the U.S. banking system is really, really important. That's why the FDIC, the Federal Deposit Insurance Corporation, exists. I think that happened during the Great Depression. I can't remember the exact act, but it's basically created to make depositors feel safe, right? And so today, like any one depositor, any one Social Security number has $250,000 of uh, deposit insurance.
got it.
So they know that at least $250,000 is safe. And that being said, this is a personal opinion. This is not a stated fact. The the Fed has made it pretty clear. The FDIC has made it pretty clear that they're not going to let a depositor lose any money
Got it.
at any bank. If you saw when SVB failed in March of 2023, all those depositors got all their money. And one of the main reasons is if there is a crisis of faith in the U.S. banking system, what happens is depositors like you and me are going to say, I don't know if I trust that bank. I'm taking my money out. I'm going to go put it. I'm going to go buy a treasury. I'd rather take that, get 2%, 5%, whatever the number is, than risk any of my deposits in this bank. And so if all that happens at once, and if all the depositors leave all the banks, then all of a sudden we can't fund our loans. We can't fund what we're doing. And there's a systemic collapse. And
Right.
so, and I shouldn't laugh when I say systemic collapse, but it is something that we have to protect ourselves against. And the FDIC does a really good job doing that. And the way the FDIC pays for itself is they assess, like banks pay for it. Basically, we get assessed fees based on our size. And if there is a bank failure, then they do a special assessment to refill the FDIC coffers. And because then the FDIC will pay out to make sure that depositors get covered.
Got it. Okay. And that when everyone would come to take their money out, that's called a run on the bank, right?
Bank run. Yep.
Bank run.
And that happened. That was actually happening in the 20s and 30s during the Great Depression. People were literally going into the bank and just saying, "Give me all my cash." And at some point,
Right.
banks actually just closed. They closed their doors and said, "You can't come in, and you can't have your money." And
Right.
and that is actually the reason today that no bank in the U.S. can be closed more than 3 days in a row. And so we get the weekends, but so like the Friday after
Bank
Thanksgiving,
holidays.
banks are open. We have to be because we cannot be closed 4 days in a row. And it's funny because it's a little bit of it's completely irrelevant now because we can close our doors and you can still go on your phone and take all your money
Right.
out.
Right.
Which is what happened to SVB. You had a bunch of they had concentrated deposits. It was a bunch of venture capitalists with billions and billions of dollars in their bank who had put it in the bank, and they all got wind that the bank might be in trouble. And from their phones, they were all on some big retreat, I think in like Montana, and on their phones just wiring out billions and billions of dollars. And I want to say like $40 billion ran out of that bank in a day, and that is hard to do. You couldn't do that. Couldn't do that even 20 years ago.
Right.
We're kind of victims of our own technological success in that way.
Holy smokes! Well,
That was one of the things that happened to SVB that ultimately.
I know. We're almost out of time here, but I do want to touch, if you can, just why did people think SVB was in trouble?
Yeah. So basically, what SVB had done is they had grown really fast during COVID, and so a lot of like the PPP money, a lot of the excess funds that people had, excess deposits, they just parked them at SVB, and this is like I said, they had a lot of venture capital, a lot of people in in California who were who just parked their deposits there. SVB couldn't lend that money out fast enough, and so in an effort to get a little bit of yield, they went out and bought treasuries. Like they went out and bought long bonds, but to get a little bit more, they were buying 10, 20, and 30-year bonds. And remember, we talked about how when interest rates go up, the value of bonds goes down.
Yeah.
Well, they had billions. I want to say it was maybe $100 billion worth of bonds. When rates went, rates went right through the roof. Those bonds were worth almost nothing, and so they had to. What that did is, since they technically had losses in those bonds, they needed to raise capital because they were just going to take a loss because the bonds were worth nothing. And so they tried to raise capital, and they tried to do that in conjunction with a couple other things, and kind of whispers got out that they were in trouble. and the regulators were looking at it and might close them down. And when that got out, like an old school bank run happened, except with new technology. And so, it's weird because most bank failures that happened in 2008, 2009, those happened because of bad loans, bad credit. I mean, we just made bad decisions. We're making 0% down mortgages, all this stuff that banks never should have done. This was one. It was the management team they obviously made mistakes. I'm not sure the bank should have failed, but yeah, there was fear, and so that bank failed. And then that was on like Friday, March 7th of last year, and I want to say that that's when it went under. And I was on a plane going to spring break, and all of a sudden, my phone lights up, SVB failed, and all my clients start calling, and that by Sunday the FDIC had resolved it, and they had figured out who they were going to sell it to. Depositors were going to get paid, but what the after effect of that was, people who had their money in regional banks were terrified that their bank was next, and
Right.
So we're sitting there trying to say, hey, look, we don't do what they did. Yes,
Right,
we have a small
right.
bond portfolio, but we lend all our money out. Like that's what my bank does, and what most banks of our size do. Like we don't buy bonds because we have clients who need loans to grow. And so, we kind of joke, we're like, hey, look, just imagine the opposite of that bank. That's what we are. It's like, if a regional bank is going to have problems, it's probably or a community bank, it's going to be tied to their loan portfolio, not their bond portfolio. They're just run differently. SVB was kind of a unicorn in a bad way, in terms of what happened to them. Like, it was there are some other banks sitting out there who have big bond portfolios that may be kind of like The Walking Dead. There are a couple of those walking around right now, but most banks don't carry that kind of bond portfolio. That was kind of a interesting decision on their part. But that ended up causing like a cascading effect that it drained deposits out of the regional banking system, concentrated them in larger banks, ultimately probably created more risk for the banking system. And then the downstream effect of all that is now regulators are being much more strict for banks of that size and smaller, because they feel like they missed something, and so they're not going to miss again.
Got it. Man, it's crazy. Like, the TLDR is just, everything is fate. Everything is fear-based. Everything is like, if you believe in it, it's good. If you don't, or if you get whiff of trouble, that's not good.
Yep. No, there's a lot of vibes, right? It's very much like, do you feel like, I mean, but it really comes down to trust and expectations, right? And so if there's a change in trust, or if there's a change in expectations, you can expect rates, return, pick anything tied to those two levers. If they go the wrong way, you have issues pretty quickly.
Yeah. Man, holy smokes. Well, William, thank you so much for giving us a lesson in, I feel like, all things finance.
Yeah, I happy to explain any more if I need to, or if there are any clarifying things, just let me know.
I appreciate it very much. And yeah, thank you so much for coming on and explaining things and helping to crave some of our curiosity. I appreciate you.
Of course.
All right. Bye, everybody.